See, excellent. Okay. All right. It looks like I have it set up, and if I don't have it set up right, Adrian, please come back. But like she said, I am Rachel Stas. I am a CPA now out of Fort Worth. I started in Dallas, so that's where I met all the Cedars Union people and stuff. So if you attended this last year or the first year, the basics are going to stay pretty much the same because there isn't a lot of growth in bookkeeping and taxes. Like the baseline is always kind of standard, but it is always a kind of a moving target as well. So there will be some updates. There'll be some stuff that we'll talk about involving COVID and like the relief that happened with there. And then tax law changes all the time. So there are a couple of changes there that we're going to talk about. But yeah, I when I was in Dallas and still in Fort Worth, I work with a lot of artists. My husband's an artist, and so I understand the challenges that you guys are facing when handling the business side of the art world. And so I'm just going to kind of give you a broad strokes, general overview of bookkeeping, budgeting, and taxes and stuff. So we'll just start with the basics and go from there. If this works or not. There we go. Okay, so starting with the very basics is once you start charging for work beyond exposure, you're gonna want to learn how to invoice. That way your customers know how to pay you and what your expectations are. So we're just gonna start with that on the line one. With your invoice, you want to make sure there are many, sorry, let me try again. There are many ways to invoice. You can use a Google Doc, you can use a Word doc. There's a million bookkeeping softwares that we'll talk about that has that. There are, if you're analog like I am sometimes, there are invoice books from Amazon or Office Depot, any of those. Regardless of which way you decide to invoice, you want to make sure that your invoice includes your client name, the date, and this is really important. On the date for some reason gets overlooked a lot, but it is, you want that to be included. So you know which year you're talking about, what month, and it makes sense. An invoice number or some kind of identifier that changes each time, so that you know which invoices are getting paid. And then obviously the amount. If sales tax is something that you are facing, you're going to want to make sure that's included as well, and as a line item. And then your invoice terms. Now, as an artist, I would assume that most of you would want it due on receipt. Because that work has already been done and it's really hard to like take your art back. I mean, I guess you can, but if it's specialized, you're going to want to get paid on hand. Now, if you do net 15, net 30, that means you're giving them a 15-day grace period to pay or a 30-day grace period to pay. But again, you want to just have whatever your invoice terms on there. Bookkeeping software will help you with that as well if you want to go down that aisle, but you can just use a Word doc. I love Google Docs, and this will come up several times during this presentation. Once you get those invoices going and they're out, you're going to want to make sure that you keep track of where they are. So what you have outstanding. So again, a hand ledger, an Excel sheet, the software will do it. All of these are valid ways. I've also had people where they will just have 2 copies of the invoice. So they'll send out one invoice and then they'll keep their copies and like mark paid on it once they've gotten paid. That is one way to do it. It can get a little cumbersome, but the main purpose of this is to make sure that you don't have money outstanding, payments falling through the cracks because you forgot that someone hasn't paid you for 2 weeks and stuff. And then now it's been 9 months and you're like, oh, right, I never got paid for this invoice. It's really hard to go back to a client 9 months later and be like, oh yeah, remember you owe me $400. Like, good luck on that. So you definitely want to keep consistent and make sure that you're keeping track of what's out there and what money you can kind of expect to come in. So once you have your invoices out and you're making those sales, you're not done. There, you need to keep track of the rest of the things that are going in your business. So that would be the rest of bookkeeping. So you need your expenses and stuff, and make sure that you have all of that. Now, hold on, I'm just making sure that I have everything. So there are a lot of options out there to keep track of your expenses and what you're putting out for your business. So you do not have to do the shoebox of receipts. Please don't give that to any kind of an accountant or tax accountant. That is the absolute worst, is to get the box of receipts. I've had a client that gave me, a previous client, they are no longer, that gave me a box of receipts, and it was like 4 different years of receipts were in it. They were so old and faded that I couldn't even tell. And I was only doing 1 year of taxes. So like, don't do that. But some options that are good options. There are some free ones out there. Again, you can start, especially at the beginning of starting your business, an Excel sheet or a Google sheet. If you don't have a lot of transactions, that's fine. Just keep track of your expenses that way. Put down where the vendor, what you bought or what it falls under. So if it was like it's supplies, or if it's an office software or something like that, like just keep track of that and the amount. That totally works. Another way to do it is, I've had some clients where they just have a business bank account or a business credit card, and everything that they use for their business only goes in that bank account or that credit card and stuff. So it's all at least grouped together. And then they'll send me statements saying, okay, all the statements, and be like, you create the books, which is not the most economical way to do it, but at least it's a way to do it beyond the shoebox. Beyond that, if you want to get some help and use a bookkeeping software, there are a ton out there. Aslo is free, but you have to have an Aslo bank account. FreshBooks and Xero, those are okay. And I have some people that clients that have really liked those in the past. My favorite is QuickBooks. And there's a QuickBooks sole proprietor option that is under $10 a month that you can do online, and you just connect your bank account, and like, I find that one really user friendly, but it's kind of whatever works best for you. And then there's Bench, and more companies like Bench that will do your bookkeeping for you, but it's pretty expensive, and you don't have a standard accountant doing it every time. They definitely outsourced it. So from month to month, you're not talking to the same person. So that gets a little like, you're kind of doing their work for them, because they always ask you, what is out there, like what was this vendor for, kind of thing. And it's like, you can do this yourself. And this is the thing. I love my artists, and you guys are so much more creative than I ever could hope to be and stuff. But there's sometimes where they just have blocks where they're like, I can't do anything because it has numbers and it has math and I can't do it. Yes, you can. You can absolutely do this and stuff. So, and especially when you're first starting out your business, you want to try. Like, you really want to get your fingers in everything so that you know how everything is working, and it'll be easier for you in the long run to pick up when something's going wrong and stuff, because you'll have a better grasp of like, oh, but no, I know what cost of goods sold is supposed to look like. So you can do this yourself. I believe in you, so do it. And remember that when you're doing these records are for you. They don't go to the IRS. So at this point, it's just whatever is useful for you, do it. Okay, so we'll go to the next slide. Now, the reason why I'm saying do it is, and I understand that bookkeeping is the last thing that anybody wants to give their time to. And this is across the board, not just artists. I mean, all of my clients, this is why I have a job, is because I'm willing to do this. But there are several reasons that you absolutely want to commit your time to this. It's totally worth it. And number one is, are you profitable? Is what you're doing right now worth it? And so and I have a lot of people who were like, oh, well, I have money in the bank, so I definitely have profit. And that is just not necessarily the case. If you had money to begin with that you put into your company, it could be that. If you have any loans, it's not going to break that out. You're not going to know what loan amount is in there and stuff. You need to keep track more than just what's in the bank account. Also, it helps you know if you're charging enough, if you think that you should be more profitable and stuff. So you want to, want to keep track of that so that you can make these managerial decisions, that you can make these budgeting decisions. And of course, at the end of the year, you're gonna have to file taxes. So having just a grip on what your profit and loss statement looks like and stuff, it helps across the board, and it does not have to be an overly complicated thing. So highly recommend. So we're gonna start first, again, by talking about the language of accounting a little bit before we get into everything else, because I want to make sure that we're talking the same language. And I've had some clients that get these things confused, so we're just gonna go through it. So this is a little profit and loss, and okay, so we're gonna go through go through the terms. So with a revenue, that can also be known as like your sales or your gross receipts and stuff. That's anything that the business has made. So it's not money that you've put in yourself. It's not a loan. If you got a PPP loan, you would not include that in there and stuff. This is money earned by the business. So that's going to be your gross receipts, your revenues, your sales and stuff, all interchangeable. Then the second line is your cost of goods sold, or COGS. And this is anything that leaves with the client. And so if you're a painter, it's going to be your canvas and the paint, and maybe the bag that it goes in, like that stuff that leaves, that goes with the client. That's what your cost of goods sold is. I have a lot of musicians, and so it's like their merch or their CDs, that kind of stuff. That's all cost of goods sold. So then you subtract, take your revenue and you subtract your cost of goods sold, and that's what gives you your gross profit. Now, if this number is negative, you have a problem. You need to stop what you are doing, because nothing is going to improve until this number is at least in the positive. So you either are going to need to increase what you're charging people, or you're going to need to find new vendors so that your cost of goods sold is cheaper or something. But your net profit, your gross profit has to be positive, or it's not a sustainable business. Then after you get your gross profit, then you add in all the other expenses and stuff that your business incurs, but doesn't necessarily leave with the client. So if you have, an office rental space, if you have, pay Cedar Union's dues, your accounting fees, advertising, that kind of thing, that's what's going to fall under your expenses. And I have some clients that when they try to do this, they get very, very specific, and sometimes you get so specific that you don't really see the health of the business, because you've got 30 lines of expenses, and you don't need to do that. You can group it. The IRS is very vague when it comes to just business expenses in general. There's only like 12 that are identified, and then it's other, and you just put what it is and stuff. So the IRS doesn't need you to be very detailed. That is for like your use and stuff. So at first, when you're doing something like if you're doing advertising expenses, you can just say advertising flat out and stuff. Well, if advertising expenses seem to be really high for you, and you want to drill down and be like, well, but why is it so high? Then you can break it out, where it's like print advertising and Facebook advertising and stuff, where you can kind of see where your money is going that way. And kind of highlight your problem areas and stuff, but you do not need 40 different expense lines. That's so overwhelming. You're going to lose the forest through the trees. So now that we kind of have a grip on what I I'm sorry, I moved too fast. So those are your expenses. And then after you take that out, you have your net profit. Now, net profit is a very important line. Everything that we talk about from here on out when it comes with taxes and stuff like that, we're going to be using your net profit number. So that is what is going to be taxed in the long run. And this is where your personal budget would start. Like that's a big point. So make sure. So you go from gross revenue to net profit. Okay. And I'm just going to pretend that you guys are giving me thumbs ups, even though I can't see you. So the next step we're going to talk about is setting up a budget. So that, and this typically will be after you have started your business, you've been in business for 6 months, you've been in business for a couple of years, and you have some history. This is where a budget comes in to like help with those managerial decisions. So, in the handout that is attached somewhere, there is a business budget form, and I'm going to hold this up, but you can't see it. And this kind of just breaks out a very simple budget. Again, you can make it to your own liking. It's just an idea of what it is. But do look at the handout. There is something there for you with an example on it. And then on top of that, budgets are personal. So I can tell you how to set up a budget, but whether or not you stick to it, that's up to you. Like no one's going to tell you to not spend that money. Like this is your baby. This is up to you on how to handle it. So I'm just going to show you how to do it. And then it's up to you to live up to it. And the reason why we like budgets is that it helps with unexpected cash flow issues, preventing unexpected cash flow issues, and it helps you see if this new endeavor is worth it at the end of the year. I mean, if you budget out 12 months and you're budgeting it out and you're not making any money, is it a passion project where you're okay with not having any, or you're like, maybe this isn't the best idea? So, or something needs to be shifted. So it really helps with managerial decisions is really where budget steps are. So if you have been keeping track of your income and expenses, which I hope you are, with the handy dandy bookkeeping software or something, this will definitely help with your budget steps. So the first step is to project what your revenue will be, incoming revenue will be. So you want to be conservative. And if you have been in business for a year and you're doing something with retail, December is probably going to be a good month for you because Christmas and all, holidays, all of that, you've sold a ton. You don't want to use December revenues when you're budgeting for January because there might not be the same and stuff. So having a year of bookkeeping is really helpful because you can kind of layer it out and say, okay, well, January is my slow month, but December is my high month and stuff. And so you can move the revenues and stuff for those months. So using your previous months and years is a great starting point. And you want to adjust for the seasonality for when your busy time of the year is and stuff. And then also give yourself a little bit of wiggle room when it comes to for unreliable payers or someone just changes their mind or, you want to make sure. Is everything okay?
Sorry to interrupt. I just thought this question was topical to this
Oh,
slide.
sure.
Angela wanted to ask if grants or stipends would go under the revenue category.
So, what depends on that is a good question, Angela. Um, it depends, which is a super fun thing, and we'll talk about this a little bit more later on in the presentation. For the most part, it depends on who it comes from, and they usually identify it when they give you the grant. For the most part, they are supposed to be taxable, but I know especially with like the PPP loan being forgiven, that is not supposed to be included. The grant with the EIDL, that is not supposed to be included. I believe United Way's grants that we're doing with the PPP, they are not included. And I think that they were setting up some kind of rule for like if it was state given, And so if it was a federal grant, then that wasn't supposed to be included. But if it's a private grant, where if you just have like a mysterious benefactor kind of thing, those are typically included. And so the big rule is if someone's going to deduct it, someone has to claim the income and stuff. So like if you go to Walmart to buy supplies and stuff, Walmart has to claim that income and you get to deduct those expenses and stuff. So it kind of depends on that. And we'll get into a little bit more, but if it is taxable, especially with these grants, they will send you a 1099, and that will be the big check mark that like, oh yeah, you need to include it. So I'm sorry, it's such an annoying answer to say it depends.
No, thank you.
Okay. So yeah, so you want to project your revenues, slide those things in, and remove from previous years, like if you got a grant, but you're not really expecting to get a grant again, kind of thing, like don't include that in your revenues going out. Those are outliers. You want to remove those. And then you need to be super honest and list all of your cost of goods sold and really be honest about this, because just making your budget look good for yourself, really that's only cheating yourself. So really get in there and put all your cost of goods sold, and then look at that gross profit. And if it's negative, you got to adjust something, right? And then we'll go to the next slide for the next part. Then again, you want to subtract all those additional expenses related to the business. So you've got your rent, your advertising, your accounting, your printing, and there are some expenses on the budget that I sent you, and we'll get into it. There are more expenses that you can lay in, but it's since it's so personal, it's really what works for you, what makes sense to you when you're looking at this. And then check out that net profit. Make sure. Now, it makes sense sometimes that if in January you buy all the supplies that is going to last you through, the next 6 months, that January might be a negative net profit, but February, March, and April are going to make up for that. So that's why you kind of want to go more than just 1 month, and I highly recommend at least doing a quarter at a time and stuff, because there's usually one good month a quarter and one not so good month a quarter, and it kind of helps even it out as you're going. But then you want to check that projected budget that you have against the actual numbers when you're doing your bookkeeping, and see and recognize what's going on. What did you underestimate or overestimate? And that way you can make those managerial decisions, where it's like if you had a vendor that was too expensive in January and you became aware of it in January or February, like, God, that's way more expensive than I was expecting, I can change it. Like, then you can make those changes and you're not ruining your year. But if you wait until November or December, you're like, wow, I really didn't make as much as I thought I would. I wish I would have known earlier to change that vendor and stuff. So that's where this is so helpful for my emerging artists. Now, do not include any of your personal expenses. You want to keep it very focused on your business. But then once you get to that net profit, if you wanted to do a personal budget and stuff, you would start with that net profit number and stuff. So that's where okay, now how do I budget so I can get that vacation? So once we're allowed to go places. So I think we covered budget, hopefully, as much as we need to. And now we're going to talk about everybody's favorite topic. Taxes, yay. So this is definitely the scariest part for my self-employed people. This seminar is focused for artists, but this in general talks about anybody. This applies to anybody who is 1099 or self-employed. And so if you have, yes, I'm an artist, but I'm also a hairdresser, this applies to being a hairdresser, getting 1099 as well. There are parameters for people who are required to pay file taxes. And so if you make under $12,000 and stuff, you're not actually technically required to paid file taxes, file your tax return. However, if your self-employment income is over $400, and that even if that's all it is, and stuff, you are required to file a tax return. Or if you had a client that you made $600, that paid you $600 or more, then you are required to file your tax return, even if your expenses were $500 and you only made $100 at the end of it. You still have to file your taxes because the IRS is not aware of your expenses. They're only aware of the income. So everything the IRS has on you is worst case scenario, essentially. And so you have to file your return to like let them know, no, that's not what I have in my pocket, kind of thing. So next part is, I get this question a lot, is when do I need you? Do I need you now? That kind of thing. It's super fun. And my basic rule of thumb is if you have a basic return where you are getting a W-2, one or two W-2s, you might have some student loan interest, but everything is really standard, and you've had taxes taken out because you have W-2 and all that, you can do it yourself. And honestly, if you're making under $72,000, you can file for free on the IRS website. So irs.gov, file for free. And it's like, look at this box, put in this number kind of thing. You can do this yourself. However, once you start having a side hustle that you're making more than $400 or you're getting 1099s, that kind of thing, that is when you want to call a CPA. And I have to add this caveat. This is new from last year. There is a difference between a CPA and an EA. An EA is an enrolled agent. They are allowed to prepare tax returns. They are not classically trained to do it. They are the people at H&R Block and stuff, they go to a weekend seminar, they pass a test, and they're preparing tax returns. They are CPA supervised and stuff, but I've had an assistant, I've dealt with people who are EAs and stuff, and has supervised is a strong word. And so you need to be careful on how someone is presenting themselves and what their background is, because I mean, just recently had a client whose CPA disappeared. She could not find her. And they were like, we are trying to do our 2019 taxes, but we don't know where she went. She disappeared. And I'm like, that is abnormal. And CPAs don't typically do that. And so I got a copy of their prior year return and looked up the woman. She's not a CPA and stuff. So, and a lot of people get confused on that. Just because you do a tax return does not mean that you're a CPA. And just because you're not a CPA doesn't mean that you do a bad job when it comes to taxes, but there is no standard that is required and stuff. So in order to be a CPA, you have to have a master's in accountancy and pass a test and do continuing education, at least 40 hours a year. It's like there are all these rules in place, and our licenses can be taken away if we are, gouging people. And EAs or people who just are preparers don't have that liability, and so they can disappear, and there's not a whole lot you can do about it. So just be careful, make sure you have the right letters after the name, or that you have backed up why they know what they're doing. That's my little thing for that. And the reasons for a CPA is we are aware of the income and expenses you should be reporting. Tax law changes every year, even in the last 2 weeks of the year, which is what happened this last time. We are aware of the audit red flags that are out there. Do not trust the TurboTax audit review. That is a wasted $40. I had a client who did their tax return through TurboTax, and they did the TurboTax audit review and came out with flying colors, and they definitely got audited. And looking at their return, they deserve to get audited. Every single thing you would not want to do was on that return. So yeah, don't that should not give you any ease. And then just if it's not for the love of the work, outsource it. If you're able to, if you're at a point where you can, I highly recommend, because I liked numbers and bookkeeping, but most people don't. So go do your art and let me do my version of art, I guess. Uh, so now we're going to talk a little bit about what is going to go into your tax return as we go. And the difference is, and first, the differences about from W-9s, or I'm sorry, W-2 paycheck to being 1099. And this is where that tax comes from and why your tax return is so miserable. And now if you have been paid with W-2 wages in the past, you have taxes taken out each paycheck, and it's not super fun to have FICA take all your money. But during it, you have Social Security and Medicare that's taken out each paycheck. Well, if you are W-2 paycheck, your employer pays half of that and you pay half of that. So they're paying into your, Social Security and your long-term retirement. And it's happening each paycheck. So it's a little bit, and it's annoying, but it's not the end of the world. When you are 1099 and you're self-employed, you're the employer and the employee. So you get to pay both sides, which equals about 15.3%. And this is typically just paid at tax filing. Excuse me. So now it's on top of your income tax rate. So most people are between 12 and 15% on your income tax rate. And then you have the additional 15% on that. So if you had $10,000 of net profit for your tax return on your self-employment, that's going to be taxed at almost 30%. And that is why it is not fun at the end of the year for my self-employed people to do their taxes. So that is why we're going to talk about how to make those a little less scary. So when you get a 1099, if you are not incorporated, which most people at the beginning are not, that 1099 income shows up on your Schedule C. Now, this Schedule C is the most audited form on your tax return because it is a business tax return that shows up in your personal tax return. So the IRS is not dumb, wildly not dumb, and they know that people try to sneak in personal expenses into it, and so that's where they're like, ooh, highlighting some issues and stuff. So that is why it's the most audited form. They also know that people like to do that because there is a real benefit of having a loss on your Schedule C, which is my job, is to make you look like you did as poorly as possible, as legally as possible and stuff. So if you end up with a loss on that Schedule C, let's say that you have those W-2 wages and then you have a side hustle that's 1099 and you're showing up on your tax return. If you made $50,000 on your W-2, you've been taxed like you making $50,000 all year long. You've been withholding that tax and stuff. Now, let's say your Schedule C is showing a $10,000 loss. That $10,000 loss goes directly against that $50,000. So now on your tax return, you're actually only going to pay tax on $40,000. So that's going to either increase your refund or reduce the amount that you owe significantly. And so that's why people really like having a loss. And the IRS is aware of that. And so they have now instituted a rule of hobby loss. So it's like, oh, I like losses and I like taking photos. So I'm going to call myself a photographer, but really it's a way to expense just my hobby of all my camera stuff. And like I get to expense it and have a better tax return. The IRS is aware that people do that. And so a hobby loss can get triggered and the IRS can stop you if you are showing a loss more than 2 out of the last 5 years. And this is the overwhelming rule, is just you need to show profit 3 of 5 years. there are other things that they can do that you can prove, like, no, it's not a hobby. I really am trying to do this. I'm just bad at it. But they look at things like your time and your effort and stuff. So it's like, if you have this Schedule C, but you also have W-2 because you have a day job kind of thing, they're going to want to see like, oh, you advertised, or you incorporated, or something that proves that you're trying to move this business forward, as opposed to just using it to get expenses. Another negative about a Schedule C is it's difficult to add any kind of owners or investors, because it's all on your personal return. So if you have an investor that wants to see how your business did, like, cool, you can show them, but like, then you're also giving them the rest of your personal return. And so if you have a family, like, your wife's stuff is on there, or, there's a lot of information that you're giving, which is not ideal. So Schedule C is a little scary. And because of that 30%, that's why we want to make sure that you're showing as little profit as possible on your tax return, but the right way. So we're going to talk now about the expenses that you can deduct. Now, the official rule with the IRS is that these expenses are deductible if they are incurred in connection with your trade, business, or profession, and that they are ordinary and necessary. So you can deduct your artist smock, or paintbrushes and stuff, but if you buy like a Chanel schmuck, no, you don't get to do that. That's not ordinary or necessary, though it might be beautiful. So that is kind of the rule of thumb. Also, I know that there are people who are like, oh, I'm going to buy all these things so that I don't have to pay any tax. And there's an element of truth to that, but you're never going to outspend like the need for taxes and stuff. So if you don't need that expense, if you don't need those supplies when you're buying them, or you're not even sure you really want them, but you're still out the money. So at a certain point, it's like, you just kind of have to suck it up on it. Okay. There is another this is included in the handout. My artist cheat sheet deduction. I know I keep showing these and you guys can't see it. But it has kind of, in general, expenses that are allowed that you can take, that keep in mind. And now I'm going to go over some of the trickier ones and the ones that have changed, so that we kind of can like zoom in on that a little bit. So mileage is my favorite one for my artists. There is a lot of expense to be had here, so that's excellent. The rate changes every year, which is not excellent. And as you can see there, it's going down a little bit, but for every business mile that you drive, you get 57.5 cents per mile. That includes the gas, the depreciation of the vehicle, standard maintenance, repairs, taxes, insurance. It includes all of that stuff. So you don't need to keep track of all of your gas receipts. You just need to keep track of the mileage that you drove. And we're going to talk about that in the next slide. This does not include parking and tolls, though. So you get to take those on top of your mileage. So make sure that you keep track of that as well. And the trickiest part with mileage is what is allowed, what is considered business mileage. So if you have a regular job and you drive from home to your regular job, you can't include that. That is considered commuting, and commuting is not deductible because the IRS says everybody commutes. So that's just like kind of a cost of living. However, if you have a second job, or if you are working with Cedars Union, going there after work and like for your 1099 job and stuff, that mileage is deductible. So you do want to include that. You want to keep track of that. This is where I would typically hand out a mileage log to everybody, but yeah, virtual and stuff. But there are a lot of apps. Number one, you can buy a mileage log off of Amazon, Office Depot. There are apps. Mileage IQ is really nice, but you have to be really diligent of like turning it on. I'm going to pick up supplies and stuff before I go to the workspace, that kind of thing. Like that is deductible. You want to keep track. You can estimate your mileage, but when you estimate mileage, you typically leave expenses on the table doing it that way because you're always going to underestimate. And you want to make sure you're underestimating instead of overestimating. The IRS has access to your odometer readings. So when you get your oil changed, they put that in the system and the IRS has access. So if you're going to estimate, make sure that it is a reasonable amount, because that the client that got audited was one of the things they did was pick, oh yeah, I drove 30,000 miles. And they went, oh, that's interesting because your car only went 20,000 miles. And the IRS is never going to believe that 100% of your mileage is business anyway. So you really like keep track. If you have a pretty standard working arrangement where you're like, okay, it happens every Thursday and Friday, kind of thing, maybe you can do it for a month, keep track of your mileage and then times it by 12, something like that would work. But if you were to get audited, the IRS is going to want to see some support of those miles where you went. So that stuff to keep in mind with that. And another little side thing, when you are driving, like if you were driving from your home office from in Dallas, to Fort Worth to do a mural, that mileage counts. Driving there and back counts. Even if you like pulled over to like have dinner and stuff or run a personal errand, you still get there and back. So you do get to include that regardless of where your car actually goes and stuff. So that part's nice. But things to keep in mind. Okay. Oh, I'm sorry, guys. I'm going to have a couple of like not super fun things to talk about when it comes to expenses, but I promise at the end, it gets better. So the next one is your home office deduction. This is where people can really get in trouble because they like to take advantage because we all work from home, especially now everybody's working from home. But the big rule of thumb on the home office deduction is it has to be exclusive use. So putting an easel or putting your laptop in a guest room and that has a bed in it doesn't count. You don't get to be a guest room and a home office. That is like the number one, like big no-no. Putting your laptop on the dining room table does not make your dining room your office space. So don't go that direction. If you do have a second bedroom that you have converted into an office space, that does count and stuff. So the way that deduction works is you could either do the standard deduction, which is $5 a square foot for up to 300 feet. So you could have your $1,500 deduction, boom, you're done. Or if you have more expenses than that, and so you're in 1,000 square foot house and your office is 100 square feet, then you get to take 10%, that percentage. So 10% of your utilities, 10% of your mortgage interest or your rent. If you had a major repair, like you redid your roof, you can take 10% of that as well. And those are all considered indirect expenses that you can put down and take that percentage. Now, if you actually do, and this happens more for my musicians, but if you outfit your home office to be able to record and stuff, so you put a lot of padding and making, that can get very expensive. That is a direct expense, even though it's considered like a repair. And so you can take 100% of something that you do directly for that office space. So that's awesome. You get to do that. However, your home office deduction cannot be the thing that makes you in negative or a loss and stuff. It ends at zero and stuff. So if you have $300 worth of profit and then you have $500 of home office expense, you only get to take 300 of that home office expense to zero it out, but you can carry the leftover forward. That's a lot. So that's my very quick home office deduction. The next one, I told you, no cell phones. That's not deductible any longer. I'm sorry. It hasn't been deductible for a while. The IRS I know everybody works on their phone, but the IRS is saying you're going to have that phone regardless if you had a business or not. If you get a second phone, the cost of that second phone could potentially be deductible. They prefer it not to have internet on it. I mean, it's insane. Old people write these rules. I'm just the messenger, but in general, if you only have a cell phone and you do business and personal on it, it just is not deductible. If you buy a separate line, the cost of that separate line could be deductible, but that's kind of where we're at. Meals and entertainment. This has changed. This is the rule that changed in the last 2 weeks of the year. Well, it changed in 2017 and then it changed again. So entertainment is no longer deductible. So if you were bringing clients to like a concert in Deep Ellum or a Mavs game or something like that, I'm so sorry that it just straight up is just not deductible anymore. Meals can potentially still be deductible, and they are usually deductible 50% deductible. But the big rule that just changed is that if you go to lunch or go to a restaurant and they provide the food and the drink and you're talking business, that is now the 3 martini lunch, if anybody's heard that in the news, is 100% deductible. So yay on that. But if you go to lunch, or if you go on a business meet, if you go to lunch even with a partner or bandmate or whatever, and you don't talk about business, that is considered entertainment. So it is supposed to still be business related when you're doing it. How is the IRS going to know one way or another? You need to protect yourself. So if you do have an expensive lunch that you're wanting to deduct, I recommend saving the receipt and writing at the top of that receipt who you were at lunch with and what you talk about. It does not need to be a paragraph, but it could be, me and Jeff Barry at ArtCon. That's all it needs. And shout out to Jeff. So there's my example for that. And then the other part of it is travel meals. If you have a client that is in Austin, and so you went from Dallas to Austin to paint a mural and you're going to be there for 2 days and stuff, all the meals while you're there are considered business meals. You do get to deduct them, but those are 50% deductible. If you had a client in Fort Worth, but you were just there for 2 hours and you were able to make it home, that is not considered a travel meal. So the rule of thumb is if you were able to eat at home, then you don't get to consider it a travel meal. But if you're not able to eat at home, even if you don't, then you get to deduct it. So that is meals and entertainment, and we're almost done. I just real quick want to talk about charitable contributions because this changed as well. So for the most part, especially with the new tax law that came out in 2017, the standard deduction is so high for most individuals that they aren't able to deduct their charitable contributions, because you have to be able to itemize your tax return to get your charitable contributions in there. So if you don't have mortgage interest and like substantial mortgage interest and real estate taxes and stuff, most people do not qualify for it because you have to itemize. And this is not business itemized, this is personally itemizing. But if you're lucky enough that you get to, great. Time is not deductible. And I know my artists with their big hearts do a lot of charitable work. You just can't allocate it. So you can't say, oh, well, I charge $150 an hour. And I worked 40 hours, so I'm going to deduct. It isn't. Time just straight up is not deductible anymore. One thing that did get added in this last year with the COVID times is that there is up to a $300 charitable deduction that you get to take just straight off the top if you did it with cash. So I don't think that if you did Goodwill donations that's included, but if you donated to a COVID charity or church or just any United Way, any normal charities and stuff, you do get to deduct up to $300 above the line, and you don't have to itemize to be able to do that. So that's the new one with charitable contributions. Oh, okay, so we got through all the not fun stuff. Now we're going to talk, man, I'm running out of time, about ways to reduce your taxes And so I promised it was worth it. And so real quick, I get asked this a lot too. What is the difference between an LLC and a sole prop? Now, a sole prop means that you are not incorporated with the state, and you can do everything and with a sole prop under your social security number, which isn't ideal because when you're getting 1099, your social security number is everywhere. Um, but an LLC means that you're incorporated with the state. Your business is now its own entity outside of you as a person. So it helps you a little bit with liability protection. I'm not a lawyer. This is what a lawyer has told me. Now, so you have your LLC or your sole prop. Most people are working under a sole prop at this point, but either one of them can qualify for an EIN, which is basically your business social security number. So it just protects your social security number. It doesn't protect you legally in any kind of way, but a sole prop can apply for one as well, and an LLC kind of has to. You can apply for these for free on the IRS website. It is not challenging, irs.gov, and EIN, you just put in what you are and they generate a number for you. So don't pay LegalZoom $80 to do it. But I highly recommend the LLC, not just because of getting an EIN and stuff and separating your business, but the liability protection that comes with it. But also, in order to elect to be an S Corp, which is the magic lower my taxes button, you have to be incorporated. So you have to be an LLC first, and then you elect to be taxed as an 1120S. And what the 1120S says, and we're going to go over this briefly, and this is where this is a step you want to take, this is when you ask an accountant to kind of more specifically apply it to you and if it's worth it. But for my clients, if you are having a net profit of over $15,000, that's where I kind of think the sweet spot is to make it worth it. And what it is doing is it's pulling that business return off your Schedule C and off of your personal taxes and creating its own business return. So it's telling this is where your expenses are. It's not audited as much because it's not on a business return. Your personal return. If you want to add a partner or an investor, you can show them your business and it's only your business on it. And the best part is that net profit that shows up on the 1120S, it flows through, it doesn't pay its own tax. It flows through back to the personal return, but that net profit is not subject to self-employment tax. So that extra 15.3% is no longer there for that income. So a $10,000 profit on that Schedule C versus the $10,000 profit on the 1120S can save you $1,500, just right there. So there are a lot of other steps with an 1120S that you need to work into and kind of hear more about. But if that is something that is interesting, it takes about, I would say $15,000 makes it worth it, because you are going to have to pay for a second tax return. You do not want to TurboTax that and stuff. You have to pay to be incorporated, and the LLC fees are $300 alone, plus if you pay someone to do that for you and stuff. So it's things to keep in mind, but there is such a thing as a magic lower tax button, and it's called the 1120S. So I'm big fan, but we're gonna have to move along. So the next thing is, don't ignore your taxes just because you're scared of them. I understand the IRS is very good at being scary, but if you have 1099 income out there, the IRS has it. If someone has asked for a W-9 from you to fill out in order to do they sent a 1099 to the IRS. Whether or not you received it, the IRS doesn't care. You can't be like, oh, but they didn't send me the 1099. They expect you to keep that revenue, keep track of that revenue. So you want to make sure that you stay on top of your taxes, because once they will find you, but it might be several years, and then you have penalties and interest that are just so much higher, and you can get on installment plans and stuff. That part is not hard. Like it behooves you to just stay on top of it. And then the other thing that has come out in the last few years that I've seen a lot are, I feel like they are very aggressive predatory loans. And I saw this a lot with COVID times, that PayPal and Square, if that's where you're using for your merchant services, will be like, oh, hey, you qualify for a $3,000 loan. Do you want one? And I don't know anybody that would be like, oh, I don't want $3,000 and stuff. So there's like, okay, yeah, they sign up for it because PayPal and Square, like, because what we'll do, you don't even have to make payments. We'll just take a little bit more in fees as we go. The problem is there's an initial fee that happens. And then those little fees that they're taking every time you swipe that card and stuff, they start really adding up. And so at the end of the month, you're like, wait, I'm still like, I'm shorter than I thought I would be, even though I did better in business. And so, and what they're doing is they'll give you a little loan at first, and then when you get close to paying it off, they'll go, oh, hey, now you qualify for a $7,000 loan. And they're counting on people to take those loans and buy things they don't need. And so there is a difference between, absolutely, I have to have, this welding kit to be able to do my next project, versus, oh, it would be nice to have like a better salon chair. Like, they're counting on you to spend money that you wouldn't necessarily spend, so that they get that interest and stuff. So really, a good rule of thumb is any loan that goes looking for you is not a good loan. So I just highly recommend don't go down that path, and really only spend that money if you absolutely have to. And now we're going to move on to nicer loans, sort of. So if you had a 1099 in 2019 and you're going to get one in 2020, you could qualify for the PPP loan. And that's the payroll protection plan loan. They are going to look at that Schedule C and what that net income amount is. So that would actually be line 31 on the Schedule C. If that is a positive number, divide it by 12 and then times it by 2.5. And that is what your loan amount could be. So if you didn't take a first draw, you could still apply for taking that by March 31st of this year. If you have already applied for the PPP, they are allowing a second draw at this point. So if you have made 25% less in 2020 than you did in 2019, you could qualify. So like, get in there. The big thing is the brilliance of the PPP loan is that it is forgivable. And especially with my 1099 clients and stuff, all you have to do is pay yourself 100% of the money. Well, ta-da, you're going to do that. So it's going to be entirely forgivable, most likely in your circumstances. And so that is a big pro. The first step, though, in most banks require you to have a business bank account, and you needed to have one before this started. So if you have one, great, go for it. And for sure, check with your banker, even if you don't have one. Maybe there is a way to get in there. Every bank is different. There's not a hard, fast rule on that. But the first step is definitely to talk to your bank and your banker, and then talk to your accountant if you need. But going, hey, I'm going to apply for the PPP loan, do it for me, to your accountant won't work. You need to get the list of things that you need from the bank, what the bank is requiring, and then your accountant will probably be more helpful. At least that's how I work, with, okay, here are the forms that you were looking for. So we like PPP, forgivable, excellent. EIDL is the Economic Injury Disaster Loan. It's not forgivable. It is a very favorable rate and stuff, a very low interest rate, and you don't have to pay on it the first year you have it. However, the moment that those funds hit your bank, it is accruing interest that first year. So it is not free for a year. I've had a lot of people like, oh, I just put it in the bank account just in case I need it, but I might give it back. Well, they're accruing interest for that safety net. So you really, if you don't need it, don't go after it. Just stay away. It's not, it isn't forgivable beyond the initial $10,000 grant, and that gets rolled into the PPP anyway. So just, I just want people to keep that in mind. Also, the EIDL has some pretty specific limitations on what you're allowed to use it for. And so again, talk to your banker on that because it varies, but proceed with caution when it comes to the EIDL. And I'm sorry. And for the PPP, you have 10 months from when you receive the money to ask for forgiveness. So make sure you get that on your calendar so that you don't have to miss that opportunity. But yeah, yay for PPP. Okay, and so I'm going to my final thoughts, and I just want to talk to you guys. Whether you decide to do your own bookkeeping and taxes, or have an accountant do them, outsource them, knowing where your business stands is paramount to succeeding. Making money in art is a business, and the IRS is going to tax that business. But staying on top of your situation and your tax filings is just make sure that they don't get more than their fair share. So want to make sure that you guys have that. So with that, I guess I'm done. So does anybody have any questions?
They do. There's a
Oh
bunch.
God. It was a little scary seeing it pop up.
Sorry, I warned you that it would scare you. Hey, that was great, Rachel. Thank you. All right, so I'm going to start cruising through some of these questions. And guys, I know that there were some questions in the chat. If this is a great time to go ahead and add them to the Q&A, if there's anything you want added here. Okay, so we have 2 questions from Katrina, and she wants to know that if you're employed with a job that has a W-2 and you're a sole proprietor of a business, how do you manage that? I mean, I guess they're taxed differently, but how do you manage that when you lump them all together with your income?
Oh, sure. So with the W-2, that is just straight up, you're going to just put it in, you're going to keep them separate, basically. So you want to keep track of your business expenses and that business income, from your 1099, and keep those segregated. Any expenses that you're incurring when you're a W-2 employee is not deductible. They took that away with the 2017 tax plan and stuff. So if your employer can't reimburse you, like none of that falls and stuff. But with your Schedule C, you can have both of those. Just I'm sorry. Does that make sense? I need her.
Yeah. So like
nod.
if you buy something, like if you buy a new computer because you're working from home a lot now and your employer didn't get you one or something, you can't, in your W-2, you can't write off that computer. However, if you
you can't write that computer off if you're using it for both. Sometimes you can maybe do if you buy something that helps both things, you can maybe do a percentage where it's like, okay, 50%. Excuse me, I have the hiccups. I use, this printer 50% for my business, but 50% for my W-2 job and stuff. You can kind of just allocate how much you use it for. That is kind of your best bet. But really, this is when you kind of want to trigger with an accountant so that they can tell you what's most comfortable. And it really depends on how much money your Schedule C is bringing in versus your W-2 as well, because it's hard to be like, oh, I make $50,000 with my W-2, but I only use, the printer 4% of the time with that, but my, $5,000 1099, oh, it's 100%, all of my equipment is for that. And it's like, that could possibly raise red flags, but it's situational. So that's where you kind of want to ask someone more specifically.
That makes sense. Okay. And then she also had another question about if she has a commission and it's for more than $600, does her collector need to file paperwork, or does she need to send them the forms?
So the person who's paying you is actually who's in charge of sending you the 1099. They should be requesting a W-9 from you. And I meant to say this during the presentation. In the handouts, I have a W-9, a blank one for you guys, and one that's like filled out with examples on like how to fill it out and stuff. And really all it is your name, your address, and your social security number. And you can fill out one and give it to everybody and stuff. It doesn't change at all. And you just want to update that if your address updates, because that's where your 1099 is going. And like I said earlier, just because you didn't receive the 1099 doesn't mean the IRS didn't and stuff. So you want to be claiming that income. And I have yet to find someone who asks for a W-9 who hasn't been sending a 1099. So you should really act like, yep, I got 1099 for this, even if you don't see one.
Okay. Okay. Oh, this is a good one. Could you tell us what the range of cost normally is to get a CPA to prepare a tax return?
Oh, sure. So there it varies. But if it is dependent on what is actually in your tax return. So if I had someone who came to me and they had a W-2 and student loan interest and like maybe like a kid kind of thing, but nothing, they didn't have a business associated with it, that's going to run around $150, $175. Once you put a Schedule C on it, because it is technically like doing two returns, that's going to start at $250 plus. But if you go to like a big firm, you can't walk away from a return at a big firm for less than 500. H&R Block, I've seen theirs be just like as high as like $1,000, and those aren't CPAs doing it. So it really, you have to be careful, but not all practices are like me, but I hate having surprise bills. And so what I'll do when people message me or they want to know how much it is I will have them send me their previous year's return, look at that, and then give them an estimate on a range of what it would be based on their prior year return. And then if something comes up where it's like, oh wait, but you forgot to tell me that you bought a rental property and you have all these other things, then we'll have a discussion of like, okay, it's going to be more than I initially thought and stuff before the work is done. Because I hate surprise bills, and I don't think anybody else particularly cares for them either. So that's kind of my way of thinking. But I worked for firms in the past where they surprise you. So definitely it is not unreasonable to ask your accountant or your CPA what it's going to run before you give all your stuff over.
Are you still, in case anybody after all of this is like, I don't want to do it, are you still taking people for this tax season? I know it's getting close.
I am at the moment, but if you message me in March, probably not. So definitely tag this when you message me, because at this point it's like you need to know somebody before I'm like willing to take it on, because it gets to be a lot.
Okay, Chris is asking, is it best to file with a Schedule C as a part of your personal SSN, social security number, or request it through your IEN or EIN, employee identification?
That is, so for tax purposes, it doesn't affect it one way or another. I recommend an EIN just because your social security number, it's ideal not to have that out everywhere and stuff. So if you have one main client or two or three clients a year and stuff where you're only having 3 W-9s and you know that they're legit and they're going to keep track of your stuff, that's probably not a big deal. But when I have like musicians who are handing it over to like every like podunk bar in town kind of thing, their social security number is just floating everywhere. And that's where I'm like, okay, you need to get an EIN just to protect yourself that way, because you don't want someone swiping your social.
Okay. If you've been a sole proprietor, is it difficult to convert to an LLC?
Nope. Not at all. Everything stays essentially the same. The biggest thing is just paying for the state legal fees to file the LLC. And then if you don't elect to be an S Corp, if you just want to be an LLC on your Schedule C, it essentially is all exactly the same, except the name changes. It has LLC afterwards and you have an EIN. So nope, it's super, super easy.
And I'll add on to that too, Chris, or no, this is anonymous attendee.
Oh,
We do a lot of work with Arts Council Texas, which is a legal advocacy group for artists, and we'll start our programs up with them soon. But we actually do a legal clinic program where you get one-on-one attention from a art law professional, I guess I should say, and they can help you sort out any of those things too. In case anyone else is listening, they're like, "Man, I'm not an LLC." They'll give you all the reasons why you should be or why you shouldn't. It might not make sense for you if you're only like kind of pulling in some money as a side hustle, but the more serious you get about it, it's a lot about protection, like you said.
definitely. Yes. And with the LLC, like if you're trying to avoid the hobby loss rule, becoming incorporated with the LLC, that's one way that you can say, like, no, I'm legit trying to do this kind of thing. But something to keep in mind with an LLC is if you start one up and then a year later you're like, yeah, no, I don't want to do this anymore, it costs kind of a lot to get it shut down too and stuff. So you're looking at least a $40 fee with the Secretary of State. You're having to dissolve the LLC. And so there are costs involved if you have your accountant do it or your lawyer do it and stuff. And like accountants can set up LLCs, they're allowed to, but we are not allowed to give you legal advice on why you're setting up the LLC. We can only do it because it's for tax purposes. So like I'll set it up for my client. I'll set up an LLC for a client because they want to become an S Corp. Like that's where my limitation is on that. And I only set up LLCs for sole props. If you have a partner or you want to, have multiple people in your LLC and you're not married, get a lawyer. You need a partnership agreement. Big time. Get the lawyer, but get an accountant first, and then they can tell you if you need to get a lawyer.
Before March. Okay. Angela says, I'm an LLC. Can I deduct the time I spend launching my art business, making my art, etc.? What is the best way to do that? Can you deduct your time?
No, that's basically what you're getting paid for. And so I don't know how you would deduct your time anyway, because that would be like so anything you deduct, someone has to pick up on the income. So like even if you were deducting your time, you'd essentially like end up having to like 1099 yourself. It's tough to pick up that income for the time. So it doesn't really work very well to do that.
Before we had everything virtually and we were doing all these lectures online or in person, we had a potter who he does some commercial pottery for restaurants around town, go over how he does his bookkeeping, because he's an example of an artist who actually at one time was in accounting, and it was what I'll say to you, Angela, is that the time spent should go into the cost of goods. So you want to find a way to keep track of the time you spend on your business so that you can incorporate it into your prices. And it's really nice if you can find sort of a more clear-cut way to do that. And so in this case, Marcelo Ortega, who gave the talk, like he created a system to account for his time and then fold them into his prices. And that's really the best way to make sure you're getting paid.
Yeah, that's a great piece of advice. And that's actually because I have a business coach as well, kind of thing. And one of the things that she helped me with last year was like identify what you want your hourly rate to be. And then, and everywhere, if you want to be paid $200 an hour, your time worth $200 an hour, put $200 on a Post-it and like have it everywhere, so that every time you're quoting someone how much something's going to cost, you have that in your head that you want it $200, like what is going to be worth my time and stuff. And so that really helped for me too. So that was a good piece of advice that guy had.
Also, there, Daryl Ratcliffe spoke a little bit about that in his artist grants webinar, which actually is on our website. And it was for the reason that when you apply for grants, a lot of the time you do have to account your time as part of what you're paid for in the grant. And so you can kind of, I think it's towards the back of that webinar if you want to check that one out. Okay, do I have to file taxes if I only did Venmo type payments and have not registered my business anywhere? My business is my only income, but it hasn't been super legit this first year.
I officially am going to say that the IRS requires you to claim all income that you make as your business. And as this is recorded, that is what I am officially going to say, even though it doesn't seem like they would be aware of the Venmo income.
Yeah, I mean, I work for the Cedars Union, so I'm a W-2 employee, and I'm also like what I call myself now at this point, an occasional artist. And I rarely sell work anymore, but when I do, I almost forget it happens because it's like such a drop in the bucket. And unless someone's asking me for an invoice and a W-9, I don't really put it into my taxes because I didn't even like put it in my budget. But I'm also not.
And if it's under $400, then you don't really have that requirement anyway. There is, at this point, there is a benefit to file your taxes just because of the economic stimulus checks and stuff that are going out. If you aren't in the system, they don't know how to find you. So that is something to take into account. And then if it is a business that you do eventually want to grow, then you want to get it kind of as legit as possible, as soon as possible, because later on, if you're trying to get a mortgage or something like that, they want 3 years of tax returns and stuff typically for self-employed people. And so it's like, yeah, there's all this benefit of trying to show that you're doing like as poorly as possible until there's actually like a PPP loan that you could be qualifying for, or a mortgage that you want to qualify for. And then you're like, oh crap, I should have showed income. So there are some outside things that is helpful.
It caught a lot of people in a bad light this past year. And also, if you're wanting to deduct business expenses and you haven't reported any income, you're not really going to get those deductions.
Yeah, well, and that the client that was like, I lost my CPA, can't find her kind of thing. That was one of the things that really stressed me out looking at their return, is that they had 2 Schedule Cs with no income and a ton of expenses. That is bad. Don't do that. Just rule number 1.
Okay, so this is being recorded, and what we'll do is I need to go through and edit out like basically the intro to make it easier to watch for you guys later, and then I will post it to our YouTube channel. But then it also, now everything officially is getting posted to our resources page. So if you liked this webinar and are trying to grow your art business in other ways, the Cedars Union has lots of nice little goodies for you on the website. If you click on programs and then you drop down to resources, we've now archived all our virtual conversations and webinars that you can access for free. And this one will be just like that. And I will email you the handout that Rachel so kindly prepared, so you can have that for yourself. Remember, if you want a wonderful CPA like Rachel, you need to contact her soon. Tax season.
And no shoe boxes.
Boxes of receipts. Any more questions? Okay, great. Well, thank you, everybody. Thank you so much, Rachel. It was great. You really do make this a
Oh,
lot
thanks.
easier to swallow. So I appreciate it. And this is a really great resource, and we appreciate your time.
My
And
pleasure.
thank you.
Thanks, guys. Thanks for putting up with me and my wobbly chair.
I was laughing a lot, by the way. Great jokes. I knew you
Oh,
couldn't see anything.
thank you. Thank you.
All
Thank you.
right. Bye,
Bye,
everybody.
guys. Have a great night.